Hi guys, I'm Chica. We're back again for another beautiful episode of our Leaders My Leverage podcast. Today we have someone I respect a lot when it comes to investing in companies, and I'm super excited to have him with us here. My boss, Davidson Oturu. Welcome, sir, to the program.
Thank you, Emmanuel, for having me. Great to be here.
Yeah, he's a partner at Nubia Capital. There's a lot I would love to learn from you today. Obviously, an hour would not cover it, but we'll just try and touch the few we can, and hopefully other people that are listening will also find value from this. First, I wanted to find out, has it how did you even get into um you know investing in companies? Has it always been something you've had in mind, or did you see something in the market as you started your career? What has it been like? What was your approach to it? How did it start? What did you see and wanted to uh, be part of it?
Thanks. So, what a lot of people don't know is I'm also a lawyer. So, I started out as a lawyer, and like we say, once a lawyer, always a lawyer, right? So it doesn't change. The good thing there about being a lawyer is you get to be inquisitive. You want to find out more. You're not just satisfied with providing services, telling people this is what the law says. You actually want to be involved in determining certain situations, whether it's for businesses or for companies or for countries. If you are a lawyer that is passionate about seeing solutions come into spaces, you just want to be involved in that. And so for me, it started out from my journey. Being a partner at a law firm called Alex. Alex is a law firm in Nigeria and Ghana, one of the larger firms out there. And I had the opportunity to start out as an associate at that firm, grew to a senior associate, and then eventually became a partner there. One of the things that I was very passionate about then was intellectual property. In fact, I would say that was what started my passion and my love for startups because tech companies generally need to have intellectual property in order to be relevant. People look at large companies like um, Tesla, Microsoft, Google, and they fail to understand that what makes those companies valuable in the first place is the intellectual property that they possess. Once they lose that intellectual property, the value of that company is completely gone. The reason why Google has almost become a synonym now for browsing. Somebody will say, okay, Google it. Is because of the Google algorithm, which is a specific type of intellectual property known as trade secret. The minute everybody knows what goes into Google's algorithm, it's all over for Google. There's no money left in it. That's why no matter the type of search engine that is using AI or different things to try and make themselves more valuable, Google still stands out from everybody else. And so for me, helping startups build from the scratch and advising them on how they needed to protect their IP was what set me along the path. But I wasn't just satisfied with giving them that sort of advice. I was like, okay, how do I go about helping them build the company from the scratch? So I decided to go take an MBA, in entrepreneurship and corporate finance, just so that I could understand the mind of an entrepreneur and what it takes to get going. And as I delved deeper in some of that, I realized that, hey, I could provide startups with all the great advice around strategy, regulatory compliance, legal documentation, and all of that. But if they don't have funding, then they will die. So I then started to angel invest in quite a number of startups. And from there, the whole thing just grew into where we are today. I also got to do quite a lot of policy work with startups. I worked with a team of very excellent folks in Nigeria on the side of the presidency, but also on the side of the private sector in drafting the Nigeria Startup Act. I had the privilege of being the lead draftsman of that law, which is to create an enabling environment for startups in Nigeria. So just working across those different segments, the private to the public to the policy to the legal side, was what gave me the passion and desire to see startups survive. And funding is the lifeblood of any business, trust me. And for startups, much more than most.
It makes a lot of sense to me, a whole lot of sense. And your passion to support startups was what got you into investments. I like how it sounds. You mentioned about, you started by angel investing. I'm curious, what were the first set of companies you invested in at that time when you were still early into investment and learning how it works? What were some of the things you were looking out for when you were investing in those startups? Those things you're looking out for then, was is it still the same thing you're looking out for now? Those startups, how are they faring? Or what would you advise someone basically that probably is getting into angel investment and really doesn't understand much about how it works? From your own perspective, from your lens, how did you approach it at that early stage with lesser experience?
Yeah. So for me, I I would say that at the time I started to angel invest, I had developed sufficient head knowledge, for want of a better way to describe it, around what it was. So I understood what it was. I knew the risks that would be involved in it. I probably just hadn't experienced it yet. So when I experienced it and I had some good successes as well as setbacks, I didn't walk away thinking, oh, wow, that was such a bad experience. I don't think I'll go through it again. I kind of knew that it was a flip of the coin. There's something that we say in business school that, and I've written about it a couple of times. There's the 1 in 10 principle. So they say when you're you're investing in startups, don't forget 1, 10, and 100. Those three numbers are important. Out of 100
How does it work?
startups,
How does it work? They want
yeah,
and tell me.
yeah. So let me explain. Out of 100 startups, only 10 will survive.
Oh,
Out of that 10, only one will succeed. There's difference between survival and success,
yeah,
just so
yeah.
you understand. So that means it's 1 in 100 at the end of the day, but 1, 10, and 100 means that you may end up investing in 100 companies. 90 will completely die, then 10 will survive. One may give you such outsized returns that when everybody looks at it, they only think of that success story. Maybe five may give you decent returns. You will just get your money back on those ones. And then three may be write offs. But that's what happens. I'll give you an example. I'll come back to my experience, but I can give you some live examples. One that I like to share is Jason Kalkanis. He's an American angel investor.
Yeah, I've
He was,
had that
he
name.
was, he was one of the first investors in Uber. He invested $25,000 in Uber when Dubai was starting out and was still at minimum viable product stage. They didn't have profit revenue or anything like that. He invested $25,000 in them. When Uber was exiting through the stock exchange, I'll ask you this question and please tell me, how much do you think Jason Kalkanis walked away with when Uber was exiting through the stock exchange? How much did he get back with his 25,000?
I'll probably say millions, maybe $10 million. Probably. Is it up
Yeah,
to
well,
that?
you tried because that kind of makes sense. He walked away with $124 million.
What?
Yes,
What?
yes. That's like 5,000 times how much he invested.
Oh,
So the 1 in 10, it is what you end up getting.
that's
Yeah,
huge.
that's huge. So the first one that I invested in was she was a fintech, and if you've noticed, I'm kind of partial towards fintech. I've done a
Yeah,
lot of
yeah, your
things there.
experience. Your
I do have a
experience.
book too on fintech law and practice.
Yeah.
In case you want to buy, or any of your listeners they want to buy.
Yeah,
Um,
I'll be open to seeing it.
yeah,
Maybe you can send me the link later.
sure, absolutely. So she had this business, a startup that was providing micro lending to market people. So I started investing in her, and the returns were really decent. Right, we had a couple of approaches towards it. There was the debt side as well as the equity. So she was paying me back with interest, but then also there was the equity that I had, which was long term. And we were doing really well because we won like a 5% per month, returns and all of that. But then the pandemic happened.
Oh,
And as you may be aware, globally
yeah,
markets were closed and all of that.
yeah.
So that meant for like 6 months, the business was at the edge. It never fully recovered after the pandemic because
Damn.
some people disappeared. I mean, some people just never came back. So people who had money took off and all of that. Those were the risks we faced, right? The business hasn't, come back. But then there were a few others that I did. There was a recycling company that I invested in, and they've done really well. They use technology to really facilitate the whole recycling process in the UK and Nigeria. And if you're familiar with waste disposal in Africa, it's not very effective. So when you have people who are able to use technology to effectively, carry out waste disposal and recycling, then there is profit. Some people say that there is profit in trash. I don't want to use the word that they use for that, but there's profit in trash. So we've seen it happen. And yeah, there was another fintech that I invested in, did well initially, crashed later on. My money is still trapped in that one as well. But then there are so many others that I've invested in, even in North America, that I've eventually invested in a few. There was one that I invested in, which surprisingly enough was a car wash, but this guy automated the car wash completely from what it was initially, and I invested in him, and I walked away with a huge profit at the end of the day, and I'm still making profit out of it as well. So most of these different investments that I was doing made me feel that that same 1 in 10 principle applies. You win some, you lose some, and I think that's the whole basis behind investing in startups. They are innovative, they are disruptive, but then if they don't get funding to keep them going consistently, then it's only a matter of time before they'll be gone.
It's a wonderful thing learning from you on the kind of your early experiences with investing in startups. But I've listened to some podcasts and had some investors also talk about a few things around the people they invest in, right? The kind of founders they invest in. Now, the question what is on my mind and what I want to learn from you, Davidson, is how do you determine the kind of founders you would want to invest in? Do you focus more on the product or on the problem they are solving and probably lesser on the individual? Or do you lean towards the individual more and a bit lesser on the product or problem they are solving? Because sometimes some people basically, invest in the individual because probably he's from an Ivy League institution or, something like that. Or maybe he has founded something in the past and they believe in him. So, to you as an investor that has been doing it for some years now, how do you see it? How do you approach it? What are the things that you see are like, okay, let's give this a shot, despite the odds of a business still failing?
Okay. So when you look at businesses, particularly startups, we classify them in stages, right? There are the type that you call pre-seed,
Hmm.
then there is seed, then there's series A, and the series keep going on, series B, series C, series G, H. Now, depending on the stage of the company, um, you will look for different things. When you're dealing with a pre-seed company, that those are companies that most times haven't started making revenue. So that's why they're called pre-seed. They are still at the point where maybe they've identified the product or service that they want to um, build. They've identified the market they want to go to, but they're probably not making revenue. Or even if they're making revenue, it's probably like $1,000 a month. They've not broken even. They are still trying to scale and all of that. With pre-seed, what you then look out for is different from what you'll be looking at with seed and Series A. So seed is above pre-seed because at seed they've refined all of those things that they were struggling with at that point. They've identified their market. They've gone to market. Maybe they're now selling and all of that. They probably just need funding so that they can build beyond where they are and increase their revenue. And then, of course, with Series A, all of those things are already done. Maybe now they've conquered Nigeria. They want to conquer the whole of Africa or the whole of Europe, different stages. So with somebody at pre-seed, what you'll be looking at will be things like the founder and the composition of the team. So that's why you hear people say, "Yeah, I look for the founders." If it's a Series A company, a company is supposed to be profitable, and they're not making profit,
Mhm.
it does. The charisma of the founder may not matter because you're charismatic like this, but your company is almost dead. Like, explain it to us. But because at pre-seed, they've not yet gone through battles yet. They've not experienced certain failures and shock waves, and their financials are not showing you that this business is a failure. So at that point, the charisma of the founder matters, and the team he has surrounded himself with also matters. So, for example, if you are a software engineer who came up with a great idea and your team, and maybe you're like an ex Microsoft or ex Oracle guy, your team, maybe your chief financial officer is ex Goldman Sachs, or ex Morgan Stanley. Your chief operations is maybe like ex Accenture, something like that. Your CTO is maybe, like you are composed with people who have pedigree, and you yourself understand your product, service, your market so well. The investor will look at those things and feel this person clearly knows what he's doing. So that would be that. But then also your market. Do you have a go-to-market strategy? Is there product market fit? You know, is this business scalable in itself? Those things will be looked at for pre-seed. When you are now at seed, your team may not so much matter because it will be expected that for you to have moved from those elementary points to this point, you already have all of that sorted out. You will now be looking at the viability of the business. So is this something that can generate the right type of revenue? And what is their projection towards breaking even? This product or service, is there a strong demand for it in the market? And even if there is this person in the right market for that product or service? And then at Series A, you're probably asking yourself, will this business ever become profitable? So there are different things you look at depending on the stage of growth of a startup. Some people may look at things, and conflate it all. But for me, I'm always very deliberate around what I'm looking at per stage of the business. And if somebody
Yeah,
at a seed or Series A has a really terrible team, then they shouldn't even be in business in the first place.
I agree. It sounds really, it is what it is, and I agree with you because every stage of the business would require a different level of approach, and from the investor, there are a couple of things like you mentioned that he will look at. The things he will look at when it's like still ideation and haven't even got a product market fit is different from what they'll look at when it's like you know Series A or above. Now let's turn our eyes into a couple of mistakes you have noticed that entrepreneurs make at the very early stage, that has probably made you shy away from investing in certain um, businesses. I'm sure there are probably some businesses that you probably initially wanted to invest in, but at some point you had second thoughts, and probably what are some of those things you probably have seen that you like, oh, this is probably what I thought before, and you decided not to proceed? That's number one. And number two is, what are some of the mistakes you've noticed both African founders and entrepreneurs all around the world actually make, that to them they might think it's actually to the good of the business, but it ends up actually ruining the business, maybe because of ignorance, lack of experience, skill gaps? What are those things you have seen? Because of course, you as an investor, you've interviewed and had a conversation with a lot of businesses, so you have more insights, more than some other entrepreneurs. So Based on this, what are some of the things you've noticed, the mistakes they've made, and probably you don't think it should be like that? Yeah, would you mind sharing with us?
You know, I would say that for your first question, I mean, there are businesses that we wanted to invest in, but when we do our due diligence, we probably see a few things in there that don't add up. There was one of them that had a very high revenue, but when we looked at their taxes, they were clearly underpaying tax, and we were concerned about that. But when we raised it, they said, well, that everybody does it that way. So that was why they did it. And for us, that was a red flag because if a number of people or your contemporaries are not doing things the right way, you should be able to do things properly because you want to appeal to certain types of investors. If we all did things the wrong way, there'll be chaos, like all over the place, right? So I would say that for any startup that wants to go to market to raise funds, you always have to make sure that you are doing things in accordance with the law because any investor who wants to put money in you would definitely want to be sure that they've backed the right type of company. There was another one that when we were at the due diligence stage, everything was looking fine. Then we suddenly saw them introduce some documents in there where they were trying to increase their salaries, like even though their salary was something else, because they felt money was coming, they now backdated a letter to show that salary was supposed to take effect. And salary was maybe like 5 times more than what it was before. So it raised questions around integrity, right? Because what would then happen when you have all that money? You know, you could just probably get a country club membership or something and want to start living large. Which takes us to your second question. Some mistakes that I see, startup founders make is failing to realize that the money that they receive is not theirs to spend. Maybe they realize it, but people get slush with cash sometimes. So there is that desire to live the life that is commensurate with all of that.
Yeah.
And rather than putting it into building the business and really growing it and giving the same drive that took them from point A to point B, they feel it's now time to spend. I think the time will come when you would make enough money to do that. Someone like Sam Altman, the founder of Dopun AI, right now, he can spend as much money as he wants, right? Elon
Of
Musk can
course.
spend, and he was giving $1 million away for free during the US elections. That's how wealthy he is, and he's still at least either the wealthiest or the second wealthiest man in the world. Can basically do that with his money. But if you startup founder, you just received $5 million, and then suddenly now you've lost it. It raises questions, and we keep seeing startups failing repeatedly because of that inability to understand the place of frugality and just building to a point where you can successfully get out of that place where you are and really live that life that you feel that you want to. Just yesterday I was still speaking to someone who was sharing with me how and I'm not going to disclose the name of that startup, but a startup that is looked at as doing quite well, but right now they are basically on the verge of bankruptcy. You know,
Whoa.
and that's because money's got missing, basically. But money doesn't get missing. People spend that money,
Yeah,
but
it's spent.
yeah. So just understanding that it's not yet time to live a certain lifestyle. You know, you need to really put in the work and make sure that it gets to that place where it is worth it all. I tell people this: look, startups are disruptive and all of that, but you're still a business at the end of the day. I think a lot of startup founders don't realize that just like any other business, like your mom and pop store or your cement factory or your construction company, you are that kind of business that needs to grow at a point, be financially prudent, get to the point where you can buy cars for yourselves, for your employees and all of that. You have to go through that point. The money that you receive as investments is basically like if you take a loan from a bank. You don't take a loan from a bank and then use it to buy a car or to buy a house to the Bahamas. You use that money and you plow it into the business so that you can make profit and you can pay that loan back. Think of it that way.
Yeah. And I think a lot of them get it wrong. They think it's just, they get the money, the next level, they buy a house and all the kind of things. Those things are good, but, just like it is said, everything has time. So I guess they will have to put in the work first before it's time to, flex and have fun. I'm curious about how you approach investing in companies based on their business model, right? Some investors have always said, you know what, if it's not B2B, I'm not doing, or if it's B2C, I think I'm more attuned to that kind of business model, or if it is both of them, fine and good. Um, I know you mentioned about investing in a car wash company, which is more like B2C. How do you, are there a particular set of business model they're like, this one, I'm going all in on it because maybe because of your experience in fintech, or maybe your experience or successes in similar businesses in the past. And for people thinking of starting a company, would you advise them based on your experience to go for this kind of model? Maybe because of its profitability, predictability, and less volatility. What's your take on that?
Yeah. So usually, as an investor, you go in with an investment thesis, right?
True.
And your investment thesis can be sector agnostic, in which case you invest in any and all types of businesses, regardless of their segmentation. But usually, as a fund, you could be sector agnostic or you could have certain sectors. So people may be a climate tech fund, for example, meaning they only invest in climate tech. Some may be health tech, some may be fintech and all of that. So your investment thesis determines, first of all, the sector or segment you'll be looking at. For me, really, in Nubia Capital, we have about five areas that we look at, five sectors. That is fintech, health tech, ed tech, clean tech, and ed tech. Did I mention that? And agri
Yeah.
tech. So those are the areas that we look at. In terms of whether it's B2B or B2C, it might not really matter because what matters is the problem and the solution. Is the problem real? Because we have situations where some people fabricate problems and say this is a problem, and I'm like, you're going at it for like 30 minutes. I'm saying I don't see this as a problem that requires a solution, or even if it is the problem that needs a solution, that is not scalable. So I look at what sort of problem is this, whether it's in the B2B side or in the B2C side. I'll give you an example. That car wash that I angel invested in, the problem was the city where that car wash was located, snow falls there like 7 months in a year.
Are you
So they have
serious? That's like more than
seven
half
months
of the
of,
year.
yeah. So they have 7 months of snow and then 5 months of, like regular weather. So cars get, like there's snow, there's fields. Most of these trucks and trailers, there are a lot of them moving along those routes. So they need to get washed, right? Or else they won't be able to see at night and all of that when they are moving. So, and it's a 24-hour service, which was what the automation was going to do because you wouldn't now need anybody there. You could just automate it. You just go, you pay, and then you wash by yourself, and then you move on. So the problem was a big one, which is it snows a lot, and then some of these vehicles need to stay clean so that they can see. And then the solution is having an automated one because most of these vehicles move at night, so they can always go there and wash their cars. So it's whether it was B2C or B2B didn't matter, if you get what I
Yeah.
mean. What
Mm-hmm.
just mattered was, okay, will this business be suitable for this place, and is it going to make a profit? So sometimes that's where you look at it. We also consider the um, profitability of the business as well as the social impact side. So and so at Nubia Capital, we say that we invest in zebra startups. Then our color really is like black and white. If you look at it, it's black but on a white background.
Mm.
Basically what you may call hidden. Trying to remember that word now. But just something that is there.
Hmm.
So on one side is profit, on the other side is the societal impact that they make. Because when you're investing in Africa, really you are solving problems, real problems, as opposed to some fly by night solutions that people prepare now.
Yeah, sometimes like when you were talking about that business, the car wash business, I'm just thinking like you know, this is common sense basically and instinct sometimes. That's how
Hmm.
I see it.
Yeah.
I've not invested in companies, but I've been reading a lot about it. But it's it's just simple, right? You can actually that kind of business could actually attend to like 100 people with nobody to attend to them. That's like automated system, and the owner can just probably be doing something else and periodically check on the system what's going on. So you can actually capture a whole lot more people with less number of persons monitoring it, which is very
Hmm.
good. Now let's move a bit into what happens in these companies that you may have invested in or that you've seen in the industry. For example, what you said about some founders not having their books set right and issues around integrity and dishonesty. Then how they manage their teams, because of course how leaders manage the people they lead plays a crucial role in the survival of the business. And you have actually advised a lot of businesses and sat at boards. What are some things you probably have noticed that happens within organizations in recent times that you think is not proper? Or how have you guided some founders that you've invested in? Because of course investment is a partnership, because those founders, some of them are inexperienced. They might have the good ideas, they might be good technically, but they might not have the right skills and experience to get to where the business should get to. And usually the investors actually advise them beyond just giving them money. So what are some of the things you've noticed over the years that some founders do that is detrimental to the growth of their business when it comes to managing people? And what advice probably do you have for anyone either starting up or currently in any leadership position that to do things the proper way basically?
Mm. No, I think I'll probably start with the second and then move to the first. I
Okay.
mean, one advice that I would give is, and I said this a couple of times, always understand that no matter how intelligent you are, if you want to grow a business that will survive the test of times, you need to be flexible enough to know that as the business grows, you need people with complementary skills to handle certain aspects of your business. If you started out as a sole founder, that's fine because I mean, a sole founder would run around, you would employ people, you would sit down for interviews, you would build the system, you would go look for money, you would market, you would do all of those things. If 3 years down the line of your business, that's what you are still doing, then there's a problem. That means that your business is not growing and you want to remain a one man business. At that point, your people's skills, no, like you are a builder, you are supposed to be executing on the company. You need to be willing to know when to bring in the right type of personnel to manage those areas. So that advice leads me to the first question, which is where I have seen these issues happen. Micromanagement is one of them. So the founder still wants to be able to look at everybody that has been employed, wants to sit down for every interview, wants to know that, like, I get it. It makes a lot of sense. But if you're spending time doing that, but you have a head of operations or a head of HR, you are basically impacting on that person's role. And the person was trained as a HR person. So the person knows how to manage the people, right? Talent management and all of that. That's not your role. But even if you started off as a HR person, now there may be some technical skills that are involved in this. You just need to be able to know how to place people in where they should be and allow them to run it. And I think the same thing also applies to financial management as well. Trying to manage the books when you don't have the necessary skills as an accountant to manage it, you're going to run into problems because there are so many sides to it. There is the bookkeeping, there's the trial balance. There are just so many books of accounts that needs to be dealt with, and you need to be able to engage the right people to take care of those things to ensure that at the end of the day there is transparency around most of that. I mean that's one area that I've seen a lot of problems arise because you're trying to find out what's happening with funding, and the founder is telling you that they've been using the money the right way. But number one, you can't see where it's been going, you can't see the results. That means that they've all been spending it without knowing where the money has been going. And that's one way that you see startups really, really fail. I think those are some of the areas. That I mean, just being able to not create a toxic environment, because I've seen that happen. It doesn't start out intentionally, but because there is a lot of pressure when it comes to running a business that unconsciously it creeps in, and which is why insulating yourself as the founder from dealing with the staff at that level is also important too, because your team members, your co-founders can deal with all that pressure, but somebody who is just in DevOps doing his own thing and is experiencing all of that pressure just creates an unnecessarily toxic environment. I think just transparency around the growth of the company and then open communication, matters. The understanding around the place of leadership and management, which are two different concepts, but people tend to conflate them sometimes. The fact that you are a leader doesn't necessarily make you a good manager and vice versa. So being teachable enough to understand where your feelings are and then improve yourself, because these are things that you can actually improve on and be a better manager with your team, but then ultimately be a good leader as well. I think just being conscious of growth, is important.
That's brilliant. That's really brilliant because you know, getting the right people and allowing them to do their thing would save you a lot of a lot of energy. And everybody, you trust that they'll do the job, and you allow them to independently execute and just ask them for feedback. I think that's a very good leadership style. Let's zoom out a little bit and talk about the African startup scene. A lot of companies in Africa are doing excellently well. Before we move into our recent unicorn, Money Point, generally in the African startup scene, when you look at the industry as a whole from an aerial view, you look at it, what first comes to your mind? That's number one. And where are African startups getting it right? Where are they getting it wrong? Before we move into a couple of challenges they face. So, when you think about African startups, which you've obviously invested in a lot, what comes to your mind, right? What do you think of? Where are these African startups getting it right? And where are they failing abysmally?
Mm. Very good question. I would say that in getting it right, they understand their market. They are building for the local environment. So they understand, for example, those in the health tech space, they understand that um, we there are very there are not enough hospitals or medical centers in Africa. So being able to provide health tech platforms that can commoditize delivery of health services, either through telemedicine, or being able to get the medical services to you. It's clearly something that on the continent you're seeing a lot of that happening. You look at the aggregation of some of the centers of tech. I'll just try and break that down. If you look at the East African region, for example, they've doubled down on the electric vehicles,
Yeah.
and then climate tech. So Uganda is very big on climate tech now because they probably realized that they couldn't catch up with some of the other regions in terms of how far they've gone. But on this one, where they
Mm.
already had sufficient climate activities, they can hone in on that. You see Rwanda, you see Kenya really big on the whole electric vehicle space, right? And then you see places like Nigeria big on fintech, big on ed tech as well. Just being mindful of what each market needs because of the challenges that they face. It's something that I've really seen that is useful and helpful. So AI is there, but AI isn't what everybody is jumping on. Yeah, like everybody's embedding AI into delivery of their services, but thankfully, people are not just creating strange products just because AI is involved in it. They're providing services that are relevant to their community. I would say that's one thing that they are getting right. In terms of what they are getting wrong, I would say that part of it is probably tied to the sort of governments that they have, because you
True.
need an enabling environment to thrive the right way that you want. So if you don't have sufficient incentives, if you don't have the right regulatory environment, and then maybe the government just says, "Hey, we're banning crypto tomorrow morning." You're like, "But yesterday now it was still fine." Do you understand?
Yeah.
So that just sets you back in a way that you may never be able to come back from at all. And so that leads to a lot of activities where people just want to probably, exit quickly, or if they see some money out of it, they just go rogue, done a couple of things like that. So I think where they're getting it wrong is tied to the environment that they face themselves and the challenges that the sort of governments that they have pose. But I think also I have seen just that um, inability to really scale up their leadership, like move from it. And it doesn't apply to all of them, but I've seen some of them, they get to the point where they are probably becoming household names, but then suddenly something happens and then everything goes bust. Now, because we don't have too many unicorns or too many really big startups in Africa, at least as of now. The failure of one is almost like we're going several steps back because the confidence and everything now starts to be questioned that, oh, this one that was the golden boy, this is what they were doing. So that means how much more will the smaller ones be doing if this one in the public eye was doing that? So I think part of what has been gotten wrong is just understanding the place of the leadership role that they play and why it is important that they stay above board in terms of what they do and how the community perceives them ultimately.
It's so comforting and good to hear that, how you itemized how African startups or where they're getting it right. And it gladdens my heart to hear these things, right? Sometimes the whole world actually magnifies failings of some African startups. Of course, you mentioned it as well. One gets it wrong, and it's like they're trying to generalize that it's all of them. Of course, it cannot be all of them. There will always be outliers. There will always be ones that will get it wrong. It's normal in every continent. But it's really good to see African founders being audacious, taking the bulls by the horn, solving really pressing problems that on a normal day in some societies in the Western world, those things are not problems. But you see founders that are really bold, courageous, and are willing to solve these problems. And the odds are always stacked up against them. A lot of things that makes it difficult, the environment that is not enabling. but yet they are solving these problems and doing an amazing work. Now, I wanted us to you're you're a leader in the fintech space. I wanted us to talk briefly on the recent unicorn coming out of Africa, Money Point. Did you see that coming? What do you think they did right that got them to that status?
Yeah, funny thing there was that I think it was probably about 2 months ago that I was telling a couple of folks how I have seen the stride that MoneyPoint has played. There was one time that I was in Nigeria and I just noticed that almost everywhere, the point of sale were MoneyPoint. They had taken over the market. Like transactions were just flowing through MoneyPoint. And so clearly you could see that they were on that trajectory. Truth of the matter is this: the lifeblood of, and I've referenced this earlier on, the lifeblood of any startup is funding. And they've been able to use the funding they've received from their investors prudently. And it's clear for everybody to see.
Yes.
So if you do well, you will be accepted. They've kept that pace of doing well. And so for me, it was only a matter of time before I would see them being crowned, the next unicorn. I think it's a lesson for a lot of startups to learn, the need to stay prudent and accountable because the investors that came in for this round were not small investors. I mean, there are people who have invested globally. So the kind of due diligence that MoneyPoint would have gone through would have been such that would determine whether that funding would come. But because they've done well with what has been invested in them before, then that funding came. So I think it's a wake up call, but it's also an amazing thing for the continent. I heard that they are in talks now to buy a commercial bank as well, which would then probably make them the first fintech ever in Nigeria to be able to acquire a commercial bank. That's not being fit. And that takes them away from being a startup to now being a full on business,
Yeah.
probably get listed on the stock exchange and be one of Nigeria's, if not Nigeria's first startup to exit through that means. So I think it's it wasn't unexpected for me, really, that I'm seeing more of those success stories next year happening.
Yeah, it's really good to see the work they've done over the years and where it has gotten them to. It's encouraging for other people that are coming up as well. So, Davidson, just to wrap up, what is one advice you would give? Number one, startup founders that are coming up. What is one specific advice you probably give them when it comes to how they build their business? And number two, um, anyone in any leadership position in any company, wherever that is listening, what is one advice you give them that would, be pivotal to the growth of their companies?
Thank you. For the startup founder, I would say always realize that you are a business at the end of the day. And every business requires structure. Every business would eventually need to turn profitable and return back investments to the different people that have placed trust in them. I think operating from that mindset is crucial as they start to scale. The environment may be challenging, but then look to those who have succeeded, and then you see that it's going to be worth it at the end of the day. Surround yourself with the right team from the beginning, because I think that's what will take you far. Just having the right team that complements each other from the beginning is definitely going to work out for you. And then be flexible enough to make a pivot, right, where required, and just create the right relationships as you move along. For aspiring leaders, one of the things that I always say is that leadership starts with self awareness.
True.
You need to be humble enough, to realize where you are. Invest in yourself. So invest in understanding your strengths, your weaknesses, and your emotional triggers. Be humble enough to ask for help. Always prioritize value creation over accolades or titles. Some people are so hung up on the title that they are not even growing. They look at the next title they will have on the belt as like a destination. So I feel in terms of being a professional musician, I always say surround yourself with professionals. That may be hard to say, but it's true. Surround yourself with professionals and then never stop learning.
That's amazing. That's amazing. I've learned a lot, and thank you so much for taking our time to have this chat with us. Hopefully, we'll have you again after a few months to ask you a few questions from another angle of investing and growing businesses. And we deeply appreciate your time.
Thank you. It was my pleasure, Emmanuel.
Yeah.